Hello and welcome to this first chapter on the introduction to finance. Here we are going to look at what finance is, the various branches of finance, and the contemporary issues in finance that are rising, including things like financial crisis. And finally, we are going to conclude with what finance managers do on a day-to-day basis. In the discussion, we are also going to cover the distinctions between finance and accounting and auditing, which sometimes can be confusing. They sometimes can be confusing. So welcome. So what is finance? That is the first question. So finance examines how people and organizations raise and spend money. How people and organizations raise and spend money. And why is this important? Like you may have covered in microeconomics, resources usually are scarce. Resources have three characteristics. They are scarce, they have alternative uses, and we can never have enough of them. So money is also a resource which is scarce. It has alternative uses. Even the money you have in your pocket now has alternative uses. You can go and buy food there, or you can buy a new phone or something else. So like every other resource, because it is scarce, it has alternative uses, and we can never have enough of it, it has to be managed. So that is why we have managers. If resources were not scarce, we would not be having managers in the first place. So finance examines how individuals and corporations raise and spend money, both how they do it and how they ought to do it, so as to produce the highest expected value from the investment. So finance itself started as a branch of business administration before being taken over and being embraced by economists worldwide. So you'll find that finance borrows a lot from both business administration, the management side of things. So you'll find us borrowing a lot from principles of management. You'll also find us borrowing a lot from economics, the microeconomics and the macroeconomics that you have done so far. So we look at the next part, which is branches of finance. So there are two core branches of finance. The first one here is corporate finance, which is also called business finance. And the second one here is financial markets. We are going to be looking at the two of them with a focus mostly on corporate finance or business finance. We are going to touch a little bit on financial markets, but in this course we are mostly going to be concentrating on business finance. So what is corporate finance or business finance? So I'm just going to read it verbatim here. So corporate finance, also known as business finance, addresses how managers of companies make real investments. How do they make investments? Raise capital, control risks, and return money to investors. So how they make investments, how they raise capital, how they plan to control risks so that the business, for example, does not collapse overnight. If you don't control risks, that is one of the consequences. And how they return money to investors. The idea of returning money to investors is how do you pay back your investors? For example, through dividends, or those people who have given you debt, how do you pay back their interest? That is what we mean by returning money to investors. So this branch focuses on maximizing shareholder value through strategic financial decisions. So what are we going to be covering in this business finance? What is covered? It is mostly capital budgeting decisions, determining the optimal capital structure, cost of capital, valuation methodologies, mergers and acquisitions, risk management, and dividend payout policies. On the other hand, we have financial markets. So again, let me just read it verbatim. So financial markets examine how markets price financial securities and guide investment decisions in portfolios containing different types of financial assets. We may have discussed something to do with financial assets before. So financial assets are assets like stocks, foreign exchange, bonds, and so on. So how are they priced in the market? For example, you have had a lot of discussion nowadays with one of the MPs, Dinyoro, arguing that the Safaricom shares are undervalued. Kenya Pipeline shares are undervalued. That is the realm of this branch of finance called financial markets. Our financial assets fairly priced? So these are the two core branches. You may have heard of many other branches, but these are the two main ones. You may have heard of personal financial planning. You may have heard of climate finance is coming out very strongly nowadays. But for the purposes of this course, we are just going to make the distinction between these two. Corporate finance is also known as business finance, and financial markets. Usually for those students who take finance to the advanced levels, you are going to be taking a course on financial institutions and markets, where you look at financial markets alone. Now, we go to the assumptions of finance. Finance operates on three core assumptions: the assumption of wealth preference, the assumption of risk aversion, and the assumption of time value of money. The first one simply says, that is wealth preference, says that people, rational individuals, will prefer more wealth to less. Think of yourself. You would prefer to have more money to less. I think it is a reasonable assumption. The second one, risk aversion, says rational individuals prefer less risk to more. Rational individuals prefer less risk to more. Think of it that way. You would want to minimize your risk. Even when you are walking home, you don't want to walk in the middle of the road so that a vehicle is going to hit you. Mostly you want to minimize your risk. That is why you want to walk on the edges. When you are crossing a highway, that is why you want to use the footpath, the footbridge, and so on. So again, I think this is a reasonable assumption. The third assumption, time value of money, says a rational person would prefer to have their money now rather than being paid tomorrow or 10 years from now. Just imagine that. Somebody tells you, I have your 10,000 shillings. Do I give you the money now, or do I give you the same 10,000 10 years from now? I'm sure you'd prefer to have your money now. And if this person was going to stay with that money for 10 years, you would expect them to pay an interest. The idea of time value of money, because they are staying with your money, then they will not pay you the same 10,000. They should pay you maybe 15,000 or 20,000 to take into account what we call the opportunity cost. The opportunity cost of you waiting for your money. So those are the three central assumptions in finance: wealth preference, risk aversion, and time value of money. Just to recap again, people prefer more wealth to less, people prefer less risk to more, and people would rather have their money now rather than later. So the idea of investment is that when you put in money into a project, you expect to make a return that is greater than its cost of capital. Just to give you an example, supposing you took money from the bank, you borrowed money from the bank at 12% interest. Would you invest that money in a business that gives you 10% return? You see, it doesn't make sense. You are losing your money. You are losing your money. You would expect, if you borrow money at 12%, you invest it in a project that gives you something that is greater than 12%, 13%, 14, 15%, unless, of course, it is a social investment. Sometimes you'll find the government, for example, investing in projects that don't make sense because it is a social investment. But ordinarily, individuals like me and you would want to invest in a project that pays you more than the cost of capital. The interest you pay for this loan is the cost of capital. If the interest is 12%, you want to invest your money in a project that pays you more than 12%. So we have several challenges in finance today. One of them is the financial crisis and systemic risks. We have had many crises in the past. We are not living in one now. I think the last one was around 2008, when we had several financial institutions collapse, and there was a major crisis around the world. Around Africa, we have a few countries that face systemic crisis. For example, nowadays, if you read your news, you are going to find that in a country like Burundi, they have a shortage of fuel, which is a major systemic risk. A systemic risk is a risk that you cannot escape. It touches on everything. Think of it today. If the interest rates go up, there is no way of you escaping it. It affects everybody. In a country like Zimbabwe also, because they are under sanctions, they have what we call a currency crisis. Every time they create a currency, it loses value very, very fast. So those are the issues. Number two, we have the issue of behavioral finance and irrational decisions. When you are looking at the assumptions of finance, we said there were three of them. People prefer more to less, they prefer less risk to more, and people would rather have their money now rather than later. But you'll come across people who like gambling, for example. People who make decisions that go against rationality. I have a friend, for example, who went to Nairobi with his vehicle. He went gambling at the casino. He gambled away his vehicle and came back to Karatina in a matatu. You see, that is something that defeats the logic that ordinary people would subscribe to. But those behaviors do exist. Things that go against the sense, what we would call as common sense. But there are people who thrive in that. We have the idea of long tail risks. That is, we have risks that are very, very rare, but are very, very catastrophic if they happen. Around, I think, 2018, 2019 in Mozambique, there was a major storm. These kind of storms that come and destroy a whole city. I think a city like Beira was heavily affected. So you can see this is an event that happens. I think the last time, they cannot even remember the last time it happened. Those are examples of what we call long tail risks. Risks that occurrences that rarely happen, but when they occur, they have very, very heavy costs. Think of it like, supposing we had an earthquake today, probably even before we were born, even the people born in the 1950s in Kenya, they have never experienced an earthquake. But imagine what happens if an earthquake occurs today. It is going to be very, very disruptive. It is a very rare thing, but just in case it happens, it is going to be very, very destructive. Lastly, we have the concept of market efficiency and hard behavior. Hard behavior is what we would call group psychology. Think of it even in your class, the way people tend to do things even without thinking, just to follow the crowd. So again, this is another type of an irrational behavior. You know what is right, this is what I should do, but simply because the crowd is saying let's go this way, you go against your senses and you simply follow the crowd. So that is it. We also have the issues of governance and regulatory balance. Let me put it into perspective. Every organization has a governance structure led by the shareholders at the top. Then we have the board of directors. and so on. So the idea of governance is how well do the governance structures work? Do our board of directors go to the company and go there to enrich themselves? This is a complaint that we have been having in Kenya for a long time. The corruption that we have. We elect MPs, governors, they go there. You know the noise we have had with the northeastern Kenya. Instead of helping people, that is what they were elected to do, bring development, they steal the money to enrich themselves. So likewise, in an organization, the people who are in charge of governing, that is the board of directors, and the managers, how well do they do this task? Those are the governance challenges that we are talking about. We also have the regulatory framework. Remember, like we said, the government is the main regulator. For example, in the financial system, the Central Bank of Kenya is the regulator. So how much regulation is too little versus how much regulation is too much? How do we strike a balance between too little regulation and too much regulation? That's the other challenge that we have. I'm not going to look at the idea of personal financial planning into details, but it is important to note that at a personal level, remember we said finance is about how individuals and corporations raise and spend money. As an individual, starting now, as young as you are, you should start thinking of retirement planning, because retirement will come sooner than you think. Even if you are 20 years old, time runs very fast. So you had rather start thinking of your retirement immediately now. So also always make sure you take into account risk management in everything that you do. When you are investing, when you are making an investment, how do you guard yourself against risk? I have had several friends who have had a lot of misfortune. For example, one friend of mine had a timber yard, kuuza mbao and furniture. So he was getting wood, I think from DR Congo, dumping it there, making very good furniture. He was a very well, a rising star, let me say. But he did not think about risk management. So unfortunately, one night, fire caught up with him. So the whole of his business was wiped out, and as we speak, he is struggling. Why was this the case? Because he did very well in investing, but when investing, he did not think about risk management. Risk management is very, very important. When you do a business, always think about risk. Insurance may look like it is expensive until you don't have it and something happens. Lastly, we have rational decision making. Like we said, we have a lot of irrational decisions. So every time you are making a decision, please sit back and ask yourself, is this the right thing to do, or am I just following the crowd? So those are the fundamentals of financial planning. So let's look at the last part. I want you to read these other sections here. What finance managers do on a day-to-day basis in an organization, that is, even at personal level. What are you doing with your money? Because remember, you are your own financial manager, and every day you do financial planning and analysis. The money I have today, I wanted to get me to the end of the semester. So every day I'll be spending 100. That is financial planning that you do every day. Cash flow management. Sometimes you realize, even after doing the planning, you will find yourself having a shortage of money in a way. So how do you manage those? How do you manage the shortages and the excesses that you have? Sometimes you find yourself having more than 500 shillings in a day. Sometimes you find yourself having no money. So probably when you have no money, you borrow money from your friend to use today. Then tomorrow you refund them. Probably when you have excess money, you put some of that money in the bank, or you put it in these funds that are coming up. Even Safaricom has investment funds, short-term investment funds, that you can do that. You do risk management every day. Think of yourself. Don't think of very far. Your own money, when you put it in a bank, it is a way of risk management, so that you don't put it under your pillow just in case even a rat will come and eat the money and you have nowhere to run to, or a thief, or a fire. Those are some of the things that you think about. Investment decisions, these ones we think about them every day. Nowadays it's very easy to even buy shares from your phone. If you have excess money, you can buy. Reporting and compliance, mostly you may find yourself at an individual level, this may not be very applicable, but in many organizations they have to write reports. At the end of the year, they have to write financial reports. That is the statement of financial position, the income statement, all those things. That is what we are calling financial reporting. It is what finance managers also do. And lastly, they advise the management on business strategy. They advise the management on business strategy. So with that introduction, you are well versed with what finance is all about, what we'll be looking at in this course. Specifically, we are going to dwell on business finance. In later courses, you are going to cover financial markets and the others. So basically what we are doing here is foundation building, and in the next lesson we are going to look at the financial system. Thank you very much, and see you.